This is the deep dive. My name's Drew Creekmur. I'm the director of advisory services here at Creekmur Wealth, and I'm joined as always by John Creekmur, our founder and senior wealth advisor. And John, today we're going to talk about something around April Fools, some things that we all need to be aware of that we don't want to be caught off guard or tricked by. Much like myself on April Fools, I do not like surprises on the 1st of April. So we want to walk through that as it relates to markets and some of the key indicators that we watch through the market cycles that can kind of be a trick or a fake out that you got to be mindful of. But before we hop into that, John, how you doing? What's been going on?
I'll tell you, I'm looking forward to spring has sprung. It's a little bit warmer weather. It is nice, and been out walking and everything. And I was actually walking on our property last weekend, and I came across a 8 point set of antlers that a deer had shed. And so it was super cool to get that and talk about how we're going to repurpose that, how we're going to use it for something as far as a decoration. And it got me thinking about just a lot of things from a financial planning element is that oftentimes we go along, we forget about things, and so we find them, and it's kind of like, oh, that's pretty cool. I'm able to use that. And one of the things I came across was actually something that I had started studying way back in the 1980s. And it was actually just kind of an investment analogy or investment analysis of what the markets look like long term. And it was kind of fun to come across that. It's kind of like when you put on your jeans or your shorts for the first time after you not worn them all winter and you find a $20 bill in the pocket. It's kind of a nice thing. And so going back and reviewing some of the stuff from Mr. Wyckoff was so interesting because a lot of the things that he talked about from the 1920s and 30s and 40s, he's an economist and a market observer, actually still hold true today. And I think it's really important, especially whenever bubbles form and whenever we see people reacting on emotions, to be aware of the trend lines that we see over time. They repeat themselves again and again and again, and it's one of the things to be aware of so you're not surprised whenever things happen.
Yeah, yeah, absolutely. And John, we had a video go out with yourself, me, and Connor, just kind of walking through what we're watching in the markets. And you mentioned the Wyckoff price cycle. This is something that we watch very closely when we're tracking market trends. It's a way for us to see visually where is the market at in that market cycle. Are we in an uptrend? Are we in a downtrend? Or have we found a price home where price is just moving sideways and we're waiting to see a breakout in either direction? And John, that really is a core philosophy for ourselves whenever it comes to how we manage our investment portfolios for our clients. We're always watching that Wyckoff price cycle, which we're going to put a picture up here on the screen to kind of just walk through for everyone. And so, whenever you're in a market cycle, you have the first phase where the market's moving kind of sideways. This is typically after we've had a sell off. This is called the accumulation phase, where really the market is waiting to accumulate momentum and begin a move one way or the other. And inevitably, there's a trigger that catapults the market higher, where we move through the markup phase. And then we reach the topping point. Now, this could be a topping point where the market takes a pause because things are getting a little hot before beginning a climb further higher, or it could be a pause before a sell off occurs. And this is called the distribution phase. And this will inevitably lead us into the markdown phase. And John, with where we're at today over here, the last 6 weeks or so, we are very clearly in the markdown phase of this market cycle. We talked about price to earnings ratios and how the markets have become very overvalued. We were due for that markup phase to begin. And so when you watch this Wyckoff price cycle, you really see that playing out with what we've experienced here for the last couple of years and definitely the last 3 or 4 months or so. And so when you zoom back out, John, what really stands out to you here?
The market moves in general patterns. We see it continuously happening over time. And we took some of our typical historical charting and we laid some lines over that over the last year. And it was so interesting. We were able to talk about in the middle of last year, or beginning of last first quarter of last year, how we really saw the top part of the market was about 6,200 points as far as in the S&P 500, and the line hit that, and then it just came back down. And so the question is, whenever it kind of reverts back down, kind of move back down to the mean a little bit. And then from there, will it bounce off of that low and move higher, or will it continue to try to find a markdown? And so right now, it's pretty clear as far as on the cycle. And we look at long term over the course of time, and we take the Wyckoff analysis there, going through the different phases. You lay it over what the S&P 500 the last 5 years looks like. It is almost identical to the market that we're in right now. And it's really kind of looking like, hey, we might be experiencing a little bit of what we call a bull trap. And so a bull trap would be whenever the market goes down and people say, hey, buy the dip, or markets always bounce back. Go ahead and buy in. Well, typically, when you hear those type of things at this point of time in a market cycle, we call that a bull trap. And so it's a trap that gets people that are perma bulls to come and buy back in and put money back at play. And really, that's a setup before we see the next leg as far as the pull down. So we think there's a high probability, Drew, that we're going to see the next waves of the pull down somewhere 5,800 to 6,000 is kind of the next topping part. And we think that's going to come up there. And cycles in the market repeat themselves continuously. And we're kind of at that phase right now as far as starting to repeat this next cycle as far as in the market pullback.
Yeah, yeah, we definitely are. And John, I know you mentioned the bull traps. I wanted to talk a little bit about that because I think it's a fair summary to say that we are the glass is always half full. We believe that markets in 8 years, 9 years out of 10 are going to be strong, but you are going to have that period of time where things really can hurt if you really miss time when you're investing dollars. And we do think the cause or the potential for a bull trap is very high right now. And so, John, when you think about just from your experience of investing, how do you avoid falling into that bull trap? What are some key elements that people need to keep in mind whenever we're assessing when and how to invest dollars to avoid falling into that trap?
A lot of it really has to do that you have to focus really as far as on where you're at, as far as on your need to access the money. And so if you're looking at a long-term investor of 10 years or longer, really we still love that buy and hold philosophy, buying high quality names and holding on to those. But the closer you get to when you access the money or a stage of life you're moving on to those pre-retirement years, you want to be careful that you don't allow your emotions to get in the way of logic and decision making. And keep in mind, we like to follow the math, we like to follow the money and follow the dollars, where are things moving, and follow the probabilities. And so you want to be looking at those things more so than the emotion. So, what is the emotion? And so we talk about this thing called fear of missing out, FOMO for short, FOMO. And so all of a sudden you see the market bounce for a couple of days, maybe, or 3 days. And it's like, I don't want to miss out on this bounce. I'm going to end up buying back in. Well, you've just let that fear of missing out on that opportunity actually drive your decision instead of allowing the math or the statistics or the probability to drive your decision. And so that is one thing you have to watch out for. The other thing you have to watch out for is undue influence from the uninformed. And so the uninformed, it could be the media. And keep in mind, folks, the media is really there to sell advertising more so than to educate you. They're not educators, they're actually there to sell advertising. And so they're going to be giving things out that really pick on your emotions. And the two core emotions are fear and greed. And so, whenever you see those emotions really being channeled from the different news media, you want to take the exact opposite approach. And so, if they're talking about something and all of a sudden you sense that fear is cropping up in you, well, then you'll want to take the exact opposite approach and look to maybe start investing. Or if you see that all of a sudden greed or this fear of missing out or trying to make money is popping up, you might take the opposite side approach and say, let's make sure that we invest. So that's the second thing, is to make sure you don't allow those uneducated to influence your decisions. And the third is you want to make sure that you have a strong plan in place as far as on how you invest those dollars and when you're going to need to access those dollars. Drew, in all three of those, I have found in working with thousands of people now all across the world, that what they really lack is having that quality individual they can really depend upon, or quality firm they can depend upon to give them sound advice, but also help them manage their emotions. And that's where we come into play here at Wealth Advisors and the phenomenal advisory staff, wealth advisors we have with us. We're talking some phenomenal as far as experience, as far as education, as far as credentials, as far as working through market cycles, and as far as spending time with those in a humble way of listening to those of us that have gone through things before. And whenever you're going through there, folks trying to say, what do we do? I would encourage you to highly lean upon a trusted resource, which that would be Creekmur Wealth Advisors, to get you the information that you need.
Yeah, John, that was a lot of great stuff there. And, I really agree with that last point. I think that's a key thing. Whenever there's a lot of volatility, there's a lot of uncertainty out there right now, going back to your plan and to your trusted advisor to revisit things to see, hey, has anything changed with our plan or with the potential outcomes and us achieving these big goals that we have? Or, hey, do we just need to make an adjustment because our stage of life has changed? And John, I totally agree. That's what our advisors are here to do for each and every one of you all. They're briefed every week by our investment committee as to what we're seeing in markets and have a very good idea of where you need to go to help you ensure that you achieve those big picture goals. So we would encourage you all, if you've not had a touch point with one of your advisors recently, reach out, schedule a 15-minute phone call, or come into one of our office locations and have an actual meeting to dive a little bit deeper into your plan and see where things stand today, and see if you need to make any adjustments inside of your investment portfolio. And John, with that said, what is one thought that you send us out into the week with?
I'd say the biggie is to make sure that you do not fall into the bull trap and do not fall into a bear trap. But right now, with market cycles, a bull trap. Do not allow your emotions to get a hold of you. Instead, stay focused upon the end goal, which that is what you're really trying to achieve, and make sure you have the logic and probability and statistics, in other words, the math of it all, lining up behind your investment decisions.
Yeah, absolutely. Love it. Everyone, thanks for the time. We look forward to talking to each and every one of you, and we'll see y'all soon.